Anatomy of a flash crash. Deconstructing the vicious cycle of macro pressures and mass liquidations in Bitcoin. The cryptocurrency market, with Bitcoin at its helm, is a realm of notorious volatility. Sharp, precipitous price drops, often occurring within a 24-hour window, are a recurring feature of this digital frontier. These events are not random acts of market chaos. They are the culmination of a powerful and often predictable interplay between external macroeconomic forces and the market's own hyper-leveraged internal structure. This analysis deconstructs the anatomy of a typical Bitcoin flash crash. As encapsulated by the statement, Bitcoin experienced a significant market downturn in the past 24 hours. Driven by macro events and mass liquidations, we will explore the chain reaction that begins with macroeconomic catalysts, such as inflation data, central bank policy shifts, and geopolitical shocks, and how these external pressures trigger the internal combustion engine of the crypto market, the mass liquidation of leveraged positions. By dissecting the mechanisms of derivatives, the psychology of a 24/7 market, and the cascading nature of forced selling, this paper will illustrate that these downturns are a violent but inherent feature of an adolescent asset class grappling with its place in the global financial system. The analysis will conclude by examining the long-term consequences of these events, arguing that while destructive, they serve as a brutal but necessary mechanism for market maturation, risk purification, and eventual stability. Bitcoin's journey from a niche cypherpunk experiment to a multi-trillion-dollar asset class has been anything but smooth. Its price history is a series of dramatic peaks and terrifying troughs. While long-term, crypto winters represent sustained bear markets, the more immediate and visceral threats are the flash crashes, sudden, violent downturns where the price can drop 10%, 20%, or even more in a single day. These events wipe out billions of dollars in market value, shake investor confidence to its core, and leave participants asking a single, urgent question: why? The provided prompt succinctly captures the two primary pillars of any modern crypto crash: macro events and mass liquidations. These two forces are not independent, they are deeply intertwined in a reflexive feedback loop. Macro events act as the initial spark, the external shock that rattles a complacent market. Mass liquidations, however, are the gasoline poured on that spark, transforming a minor correction into a raging inferno. To truly understand why Bitcoin crashes, one cannot simply look at a price chart. One must adopt the perspective of a systems analyst, viewing the market as a complex adaptive system with inputs, macro data, internal mechanics, leverage, derivatives, and outputs, price discovery, volatility. This analysis will be structured to follow the logical flow of a crash. The external shock, the macro event. We will first explore the universe of macroeconomic catalysts that can initiate a downturn. This includes monetary policy, inflation metrics, regulatory pronouncements, and geopolitical instability. We will analyze why Bitcoin, once touted as a disconnected, digital gold, has become increasingly sensitive to these traditional financial signals. The internal amplifier, the mass liquidation. This section will form the core of the analysis, providing a deep dive into the market structure that makes crypto uniquely susceptible to cascading failures. We will demystify concepts like leverage, futures contracts, perpetual swaps, and the brutal mechanics of a liquidation cascade. The human element, psychology and sentiment, layered on top of the technical and economic factors, is the undeniable influence of human psychology. We will examine how fear, uncertainty, and doubt, FUD, amplified by social media, can accelerate a sell-off and contribute to the panic that characterizes a crash. Consequences and evolution. Finally, we will assess the aftermath of such events. Who are the winners and losers? What structural changes do these crashes force upon the industry? And how do these cycles of boom and bust contribute to the long-term maturation of the Bitcoin market? By the end of this exploration, it will be clear that a Bitcoin flash crash is not an anomaly. It is a feature, not a bug, of a market caught between its revolutionary potential and the harsh realities of global finance and its own internal excesses. In its infancy, the Bitcoin market operated in a relative vacuum. Its price movements dictated more by internal community events, exchange hacks, and early adopter sentiment. However, as Bitcoin's market capitalization swelled and institutional players entered the fray, it became inextricably linked to the broader global macroeconomic landscape. Today, Bitcoin's price action is highly sensitive to the same data points that move the S&P 500 and the Nasdaq. The single most powerful external force acting on Bitcoin today is the monetary policy of the world's central banks, particularly the U.S. Federal Reserve. The relationship is simple. Bitcoin thrives in an environment of easy money and suffers in an environment of tight money. Quantitative easing, QE, and zero interest rate policy, ZIRP, the decade following the 2008 financial crisis, and especially the period following the COVID-19 pandemic response in 2020, was defined by unprecedented monetary stimulus. Central banks injected trillions of dollars into the financial system and held interest rates near zero. This had a profound effect. The risk-free rate of return, e.g., from holding government bonds, was negligible. Investors were forced to move out on the risk curve to seek returns. This flood of cheap capital found its way into high-growth tech stocks, venture capital, and, most spectacularly, cryptocurrency. Bitcoin, as a non-yielding, highly speculative asset, became a primary beneficiary of this environment. It was a bet on future growth and technological adoption, funded by abundant liquidity. Quantitative tightening, QT, and interest rate hikes, when inflation spirals out of control, as it did globally in 2021-2022, central banks are forced to reverse course. They do this by raising interest rates and reducing the size of their balance sheets, QT. This tightening has the opposite effect. Suddenly, holding a U.S. Treasury bond offers a respectable, risk-free yield. The opportunity cost of holding a volatile, non-yielding asset like Bitcoin skyrockets. Institutional and retail investors alike begin to de-risk their portfolios, selling speculative assets to move into safer havens or simply cash. A higher than expected interest rate hike, or hawkish commentary from a central bank official, can act as an immediate trigger for a market sell-off, as it signals that the era of easy money is ending or will remain restrictive for longer than anticipated. For years, one of Bitcoin's core narratives was its status as an inflation hedge, or digital gold. The logic was that because of its mathematically fixed supply of 21 million coins, it could not be debased by government money printing, and would therefore hold its value against rising inflation. However, the high inflation environment of recent years has severely tested this thesis. In practice, during periods of rising inflation and corresponding interest rate hikes, Bitcoin has not acted like gold. Instead, it has shown a remarkably high correlation to high-growth technology stocks, like those in the Nasdaq 100 index. This is because the market, for the most part, does not yet treat Bitcoin as a proven store of value. It treats it as a risk-on asset. When monetary policy tightens to fight inflation, both speculative tech stocks and Bitcoin are among the first assets to be sold. Therefore, a key macro trigger for a Bitcoin downturn is often the release of key inflation data, such as the Consumer Price Index, CPI, or Producer Price Index, PPI. A higher than expected inflation number signals to the market that the central bank will likely need to be more aggressive with its tightening policies, leading to an immediate sell-off in risk assets, including Bitcoin. The cryptocurrency industry still operates in a state of regulatory ambiguity in many parts of the world. This uncertainty is a persistent source of background risk. A macro event in the crypto context can therefore be a sudden, decisive regulatory action or announcement. Examples include SEC enforcement, a lawsuit from the U.S. Securities and Exchange Commission, SEC, against a major exchange or token project can send shockwaves through the market, creating fear that other projects or platforms could be next. Government bans. China's 2021 crackdown on Bitcoin mining and trading was a powerful macro event that led to a significant market downturn by removing a huge portion of the network's hash rate and a major source of demand. Stablecoin regulation. Any government action that threatens the viability of major stablecoins, like USDT or USDC, which form the bedrock of crypto market liquidity, would be a cataclysmic event. These events act as external shocks that fundamentally alter the perceived risk and viability of investing in the space, often leading to panic selling. Global instability and conflict also play a role. While some argue that geopolitical chaos could highlight Bitcoin's utility as a censorship-resistant, borderless asset, the more common reaction in the short term is a flight to safety. Events like the outbreak of a major war or a significant energy crisis increase global economic uncertainty. In such risk-off environments, investors typically shed speculative positions in favor of traditional safe havens like the US dollar, gold, and government bonds. Bitcoin, being at the far end of the risk spectrum, is often one of the first assets to be sold off during these periods. If a macro event is the earthquake, the internal market structure of crypto is the poorly constructed building that collapses as a result. The extreme volatility of Bitcoin is not just a result of changing sentiment, it is a mechanically engineered feature of the market itself, driven almost entirely by the pervasive use of leverage. In a simple, spot transaction, an investor buys one Bitcoin with the full amount of its dollar value. Their risk is limited to the capital they invested. The derivatives market, however, is a different beast entirely. Leverage allows a trader to control a large position with a small amount of their own capital, known as collateral. For example, with 10x leverage, a trader can use $1 of their own money to open a $10 position. If the price of Bitcoin goes up by 5%, their position is now worth $10.500. After paying back the borrowed capital, their initial $1 has grown to $1.500, a 50% gain from a 5% market move. The danger lies on the downside. If the price of Bitcoin drops by 5%, their $10 position is now worth $9.500. This $500 loss is half of their initial collateral. If the price drops by 10%, their $1 in collateral is completely wiped out to cover the loss. At this point, the exchange automatically and forcefully closes their position to ensure the loan is covered. This is a liquidation. Crypto derivatives exchanges are famous for offering exorbitant amounts of leverage, 50x, 100x, even 125x. At 100x leverage, a trader can control a $100 position with just $1. But the margin for error is razor thin. A mere 1% move against their position will result in a total liquidation of their collateral. The primary vehicles for this leverage trading are futures contracts and, more specifically, perpetual swaps. Futures contracts, agreements to buy or sell an asset at a predetermined price on a specific date in the future. Perpetual swaps, perps, the dominant instrument in crypto. They are like futures contracts but with no expiration date, to keep the price of the perp contract tethered to the underlying spot price of Bitcoin. A funding rate mechanism is used, where traders who are long, betting on a price increase, periodically pay a fee to traders who are short, betting on a price decrease. Or vice versa, depending on market sentiment. Billions of dollars in open interest, the total value of outstanding contracts, exist on these platforms. The vast majority of this open interest is leveraged. This is the mechanical heart of a crypto flash crash. It is a chain reaction that feeds on itself, turning a small price dip into a catastrophic plunge. The process unfolds with brutal speed. The trigger, a negative macro event occurs. For example, CPI data comes in hotter than expected. This causes an initial wave of selling in the spot market as informed investors de-risk. The price of Bitcoin drops by, say, 2 to 3%. The first wave of liquidations. This initial price drop is enough to hit the liquidation points of the most highly leveraged traders, those using 50x to 100x leverage. Let's say tens of millions of dollars in leveraged, long positions are liquidated. This liquidation is not a gentle closing of a position, it is a forced market sell order. The exchange's liquidation engine instantly sells the Bitcoin from these positions onto the market to cover the losses. The feedback loop begins. This first wave of forced selling adds significant supply to the market. pushing the price down even further. The price now drops, perhaps, to 5 to 6% below its starting point. The second, larger wave. This lower price now triggers the liquidation points for the next tier of leverage traders, those using 20x to 25x leverage. This is a much larger pool of capital. Hundreds of millions of dollars in long positions are now forcibly sold onto the market. The avalanche. This massive new wave of sell orders crashes the price even lower. Now down 10% or more. This triggers the liquidations for the more conservative leverage traders, 5x 10x, which represents an even larger pool of capital. At the same time, stop-loss orders from spot traders are triggered, adding even more sell pressure. This entire process is known as a cascading liquidation or a long squeeze. It's a vicious cycle where liquidations cause lower prices, which in turn cause more liquidations. It can happen in a matter of minutes or hours. And it's why crypto price charts often feature long, sharp wicks downwards during a crash. The price falls until a significant portion of the excessive leverage has been flushed out of the system and buyers with fresh capital finally step in to absorb the relentless selling pressure. The crypto market is unique in its structure. It operates the 24th of July 365. With a massive and highly interconnected retail audience that communicates instantly via platforms like Twitter, X, Telegram, and Discord. This creates a fertile ground for psychological factors to have an outsized impact on price action. During a market downturn, the information landscape becomes treacherous. Unverified rumors, bearish analyses, and out-of-context headlines can spread like wildfire. A misinterpreted statement from a regulator or a false rumor about an exchange's solvency can trigger a wave of panic selling from retail investors who fear being the last ones to exit. This FUD acts as a psychological accelerant to the mechanical process of liquidations. While the liquidation cascade is happening, retail traders watching the price plummet are also rushing to sell their spot holdings, adding to the downward pressure. As the price continues to fall, it crosses key psychological thresholds. Traders who may have bought at higher prices see their entire investment in the red. The rational desire to hold on for the long term is overwhelmed by the visceral fear of total loss. This leads to what is known as capitulation, the point at which even long-term holders give up and sell their positions at a significant loss just to stop the bleeding. This phase often marks the bottom of a flash crash, as it represents the point of maximum pain and the final exhaustion of sellers. The crypto market is also characterized by the presence of whales, individuals or entities that hold enormous amounts of Bitcoin. Their actions can significantly influence the market. A large sell order from a whale, whether for profit-taking or other reasons, can be the initial trigger that starts a liquidation cascade. Furthermore, sophisticated traders are aware of where large pools of liquidation levels are clustered. It is plausible that some actors may intentionally push the price down to these levels to trigger a cascade, allowing them to buy back Bitcoin at a much lower price once the panic subsides. A flash crash leaves a trail of financial and structural carnage, but it also serves as a crucial, albeit painful, evolutionary mechanism for the market. The most immediate result is the destruction of wealth, particularly for over-leveraged retail traders who are often wiped out completely. Confidence is shattered, and trading volumes can dry up as participants become fearful and risk-averse. The market enters a period of high anxiety, where every small upward move is met with skepticism and every dip is feared to be the start of another leg down. Fundamentally, a mass liquidation event is a deleveraging event. It violently purges the system of the riskiest and most speculative bets. In the days following a crash, open interest in derivatives markets plummets. This is, in a sense, a healthy reset. A market with less leverage is a market with less intrinsic potential for cascading failures, setting the stage for a more stable and organic recovery. Every major crash in Bitcoin's history has taught the industry a valuable lesson and spurred innovation. The Mt. Gox hack, 2014, taught the importance of self-custody, not your keys, not your coins. The ICO bubble burst, 2018, taught the importance of fundamental value and viable use cases over pure hype. The CeFi collapses of 2022, Celsius, FTX, taught the dangers of centralized opacity and re-emphasized the value proposition of transparent, decentralized finance, DeFi. The flash crashes driven by macro and liquidations reinforce a different kind of lesson, a lesson about risk management. They brutally demonstrate the dangers of excessive leverage. They force traders to be more sophisticated and exchanges to improve their liquidation engines and risk parameters. They also serve as a stark reminder to investors that Bitcoin is not an isolated asset and that paying attention to global macroeconomic trends is no longer optional. Finally, large-scale, volatile events that cause significant retail losses invariably attract the attention of regulators. The extreme volatility and the clear dangers posed by unregulated offshore derivatives exchanges provide ammunition for policymakers who wish to impose stricter controls on the industry. While many in the crypto space fear regulation, sensible rules around leverage limits, consumer protection, and exchange practices could ultimately lead to a more stable and mature market, paving the way for greater institutional adoption. The anatomy of a Bitcoin flash crash is a compelling drama in 3 acts. Act 1 is the external shock, a hawkish central banker, a worrying inflation report, or a regulatory threat that shifts the global risk sentiment. Act 2 is the internal catastrophe. The initial price dip triggers the first wave of liquidations for the most reckless gamblers, initiating a self-perpetuating cascade that purges billions in leveraged bets from the system with mechanical brutality. Act 3 is the psychological fallout. Fear and panic spread through social media, leading to capitulation selling from the retail herd. Understanding this process reveals that Bitcoin's volatility is not just a random walk. It is a systemic feature born from its dual identity. On one hand, it is a global macro asset, sensitive to the currents of traditional finance. On the other, it is the bedrock of a new, Wild West financial system rife with extreme leverage and nascent risk management protocols. The downturns driven by macro events and mass liquidations are the growing pains of this revolutionary technology. They are the market's brutal immune response, violently expelling the excesses and speculative fevers that build up during periods of euphoria. Each crash, while devastating for many, forces the ecosystem to learn, adapt, and build more resilient systems. It tempers the unrealistic expectations of infinite gains and reinforces the timeless principles of prudent risk management. Ultimately, this vicious cycle of boom, bust, leverage, and liquidation, while painful, may be the only path for Bitcoin to forge its identity as a truly mature and enduring global asset.